Kelsey, let's talk about just what it is we're talking about. What part of the market is it, and what describe how these types of loans work?
Sure. So these are unitranche financings. They're sometimes called one-stops, and what happens is that these blend first priority and subordinated debt into one debt structure. And they've really boomed in popularity this year. It used to be that it would be rare to see one that was larger than $1 billion. And this year alone, we've seen several, including a $1.8 billion one backing the New Media and Gannett merger.
So this is clearly showing how red hot demand is for private credit, but tell us exactly why they're so popular.
So there's several things driving it. For one, private equity firms really are driving the push for these. As their auctions have become more competitive, it's really important for them to have their financings tied up and ready to go before they try to buy a company. So they're turning to the private credit market, which can move with quicker speed than the syndicated loan market.
So obviously one of the things that kind of raises an eyebrow is when you hear about the first priority and subordinate bundled together. It sounds a little bit like different classes of mortgages bundled together. Who's at risk here, Kelsey? What are we worried about?
So essentially, the end investors are definitely at risk. For one, sometimes unitranche financings are further chopped up and sold, and those side agreements aren't tested in bankruptcy or restructuring situations. So that's really a big question mark as we go further on into the economic cycle.
So if there's any problem with these deals, especially given that they remain unproven and you have, let's say, distressed scenarios, then who takes over? Is it the bankruptcy courts here?
So the bankruptcy courts would be the ones deciding the final decision on this. And I want to just be clear that not all of the unitranches that we're talking about have these side agreements, but some of the smaller ones do. The more established players tend to avoid this kind of risk by not doing them.
So just in terms of kind of what's happening here, we know that they are in favor because they're faster, right, than a fully syndicated loan. Are they rated in any way? Is anybody taking a look at this to see what's inside these kind of packages?
So some private credit deals do have private ratings, but of course they aren't public to the rest of the market. It's actually an interesting piece of the puzzle because there are some really big investors in the private credit world, like insurers, for example, that require credit ratings to put money to work in this space. So it's actually having an unintended effect where the ratings agencies are getting more business for these private ratings.
So tell us a little bit about the numbers and the money that we're talking about, the volume of these transactions, and also how big the deals are getting.
Sure. So the volume hit a record $10.7 billion in the third quarter. And as I said, it used to be pretty rare to see larger ones. This year alone, we've seen about 21 deals that were unitranche financings that were larger than $500 million.